This is the Daily Market Comment by Haralambos Bisuros. I'm Maria Pashvidis. Thanks for joining us at XM.com. The US dollar reclaimed its throne on Wednesday, outperforming all the other major currencies in the last 24 hours. Yet the euro stood very well against its US counterpart, losing the least ground as Eurozone inflation accelerated to a new record high of 9.1% year over year, surpassing economists' expectations of 9.0%. With inflation in the euro area quickly approaching double digits, the European Central Bank may indeed need to act more forcefully at next week's gathering than it did last time. Thus, euro traders maintained bets with regards to a 75 basis point rate increase. The common currency could continue its recovery path, at least against currencies whose central banks are expected to hold, or are already holding, a softer stance on monetary policy. Having said that, though, persistently high inflation and a more aggressive ECB add to the already high risk of a recession, and with euro traders being gripped by such fears, the euro's recovery against other stronger currencies like the dollar may not last for long. There's a good reason why the US dollar is still king in this monetary policy saga. In the battle to fight inflation, the Fed appears to be one of the most hawkish banks, and even if some others are aggressive too, the risk-averse environment adds to its appeal as a safe haven. Yesterday, it was Cleveland Fed President Mester's turn to refuel the dollar's engines, saying that it is necessary for interest rates to move slightly above 4% by early next year and stay there. Her comments come after Fed Chair Powell and New York President Williams expressed similar views, thereby adding to the case for another triple hike by the Fed and pushing the dollar to a new 24-year high against the yen. With some investors still anticipating that rates will start declining next year, the risk of a disappointment remains well on the table, and with the Bank of Japan remaining the only dove in town, dollar-yen may be poised to conquer even higher territories. With central bank officials around the globe being more vocal about their intention to take interest rates higher, market participants continue to abandon equities and other risk-linked assets. European and U.S. equities fell for the fourth trading day in a row, with the subdued morale rolling into the Asian session today. In the FX world, the risk-linked Aussie and Kiwi were the main losers among the majors, extending their dive even as their respective central banks seem willing to continue tightening as well. This was today's Daily Market Comment. Thanks for joining us at XM.com.